Here's something I've noticed working with investors at the $1 to $10 million level. The ones who struggle aren't picking bad investments. They're building portfolios that don't match how they actually want to live. They've got too much locked up when they need flexibility, or they're sitting on way too much cash because they're paralyzed by how many options they have. The portfolio looks fine on paper, but it creates massive stress instead of reducing it. So today, I want to walk you through how I'd actually think about deploying $1 million, not as a theoretical exercise, but as an actual framework you can pressure test against your own situation and portfolio. This isn't about what to buy. It's about understanding what each piece of capital is supposed to do. This is for people who already have capital and they're asking an entirely different question. How do I make this work for the next 20 years without it becoming a true second job? If you're still in aggressive accumulation mode, trying to say 10x your portfolio as fast as possible, this probably isn't the right framework for you. At this level, I stopped thinking about individual investments and started thinking about roles. Every dollar needs an actual job. Some capital exists for flexibility, right? The ability to act when something changes. Some exists for income. Predictable cash I can count on every single month or quarter. Some exist for long-term growth, compounding that I won't need to touch for over a decade. And some exist for asymmetric bets, things that might not work out, but if they do, it's really good. When portfolios get messy, it's usually because these roles are blurred. The same money is trying to be both liquid and high growth and income producing, and that just doesn't work. Before I get into the buckets, here's the filter I run every allocation through. 1, does this produce cash flow I can actually use, right? Real distributions that come again every month or every quarter. 2, is there genuine growth here? 3, how quickly can I access this capital if I need it? And if there is a penalty, what's that cost? 4, what do I actually keep after taxes? Because some investments in income are far more efficient than others. 5, does this capital serve something beyond my own balance sheet? For some investors, that matters. For some, they may not care at all. No single investment will ever score well on all 5. Every allocation is a true trade-off. The question is whether you're truly making those trade-offs intentionally. Bucket number 1 is liquidity. Here, this can be between 10 and 20%, say 15 and 20. This bucket isn't intended to make as much money as possible. This is about buying options, right? Cash, T-bills, stuff I can access very quickly if I need to. I've seen so many investors get caught without this. They have a great portfolio on paper, then something happens, right? Job transition, health issue, opportunity they want to jump on. They're forced to go sell something that's illiquid at the wrong time, and that's very expensive to go do. Liquidity isn't truly dead money, right? It's what lets you be patient everywhere else in your portfolio. The investors who get this wrong usually feel like cash is doing nothing, but control has value, optionality has value, and not being forced into bad decisions also has massive value. Bucket number 2, predictable, consistent income. This can be between 25 and 30%. In my personal portfolio, it's over 35% because of where I am in life. This is where I want contractual, simple cash flow, right? Private credit, structured deals, things where I know roughly what's coming in and when it's coming. The goal here isn't to maximize yield. It's all about reliability. I've looked at deals that have promising 18, 20, 22% returns, right? When you dig in, you find out where risk actually lives, right? There's always risk somewhere. Higher yield typically means more risk. The question is whether you understand where that risk is coming from and whether you're getting paid enough to justify it. This bucket, I'd rather have a lower return that I can count on versus a higher return that keeps me up, checking my phone, freaking out every day and every night. This bucket itself buys patience. When your baseline income needs are covered by predictable cash flow, you can let the growth investments do their job without panic selling or freaking out, but allowing yourself that time and headspace to go truly nail those. Bucket number 3, long-term growth, right? This is in between 35 and 40%. These are private equity deals, real estate, operating companies, right? Anything where the return comes from building something over time. This capital is illiquid, and it's liquid on purpose. In exchange for locking it up, you're getting access to returns that may not exist in public markets, right? Operational improvement, value creation, multiple arbitrage. The mistake I see constantly is people putting too much here before those other buckets are solid. Illiquidity should be earned, not forced. You earn the right to be illiquid by having enough liquidity and income that you won't need this money for 7, 10 plus years. And if you're not sure whether you can wait that long, you likely can't. Bucket number 4, asymmetric bets. This can be anywhere between 5 and 10% of your portfolio. Depending where you are in life, right, this can get bigger or smaller. So this is venture style thinking, right? Things that likely won't work out, but if they do, they're very meaningful outcomes. So sizing here is everything. If this entire bucket goes to zero, nothing in your life changes, right? That's the real test. If you can't stomach losing the entire allocation, that allocation is too big. If the upside wouldn't be meaningful, even if it's 5x, it's too small and not worth your time or headspace. And here's what this actually looks like in a true portfolio. So liquidity can be, say, 15% or $150,000. Predictable income can be anywhere between, call it 30% and $300,000. Long-term growth, 40%, $400,000. And asymmetric bets can be anywhere between 5 and 10%, between 50 and 100,000, with some level of buffer room between 50 and 100K here as well too. That last 50K you can go rearrange and put into whatever bucket serves you best based on where you are in life. And your numbers will be different, right? And these numbers should be, right? Depending on where you are in your stability timeline, your income timeline, your specific numbers will be different than the ones here. Mine are even different from the ones here to a varying degree. And they should be different. This depends on your income stability, your timeline, what you already own, and really how you personally react when things shift and what your risk tolerance is. The logic holds true no matter where you are. Capital needs to have distinct jobs, and that needs to scale whether you're at 1 million, 5 million, 10 million, 20 million. Every dollar you have needs to have that specific, distinct job. This matters whether you're at 1 million, 5 million, or 10 million, or way bigger in the future too. Most portfolio problems aren't about picking the wrong investment. They're tied to the wrong structure. First, over-allocating to illiquid stuff before your liquidity and income are set. Maybe someone gets excited about a private deal, puts half their capital into that deal, into things that they can't touch for years. And then something changes and they're stuck. That is a huge issue if you cannot tap your capital and access it when you need it. This causes the most amount of stress, becoming a forced seller. Forced sellers very rarely win. Second, confusing yield with safety. A 12% yield isn't always safer than a 7% yield. Usually it comes with more risk, right? The yield is compensation for something in that deal. And if you can articulate it, understand it, maybe you shouldn't be in that deal in the first place. Third, mismatching your capital to your time horizon. Money you might need in 2 years does not belong in a 10-year fund. This does not matter how good the return looks. So most portfolios will fail structurally rather than mathematically. The returns themselves may be fine. The allocations may look normal and reasonable, but they mismatch where you are and what you need and when you can access it. That's when things truly break. And I want to be direct. Even as someone who has almost all their money in alternatives and private markets, they're not necessarily safer than public markets. They're different and they come with different types of risk. Manager risk is real. In private markets, you're betting on people, likely more than you're betting on assets. Illiquidity can also trap capital for long periods of time. And fee structures are far more complex. You need to understand what it is you're actually paying for and what you're getting in return for that. None of this means alternatives are wrong. It means they require more judgment than picking an index fund and letting it ride. If you're not willing to go do the due diligence, the simplicity of public markets may be a better choice for you. There's no perfect portfolio. Every allocation has trade-offs, right? Control against growth, income, simplicity, access, etc. The question isn't, what's the best investment? It's what problem I'm trying to go solve and what's the best way to go solve that problem. Sometimes the answer is alternatives. Sometimes it's private markets. Sometimes it's holding more cash than you may normally hold. And the goal isn't optimized for one thing. It's to build something that holds up across market cycles, life changes, and across things that you can't predict are going to happen in the future. If this way of thinking is useful, understanding capital as a system rather than a collection of investments, that's what this channel is about. We go deep on the mechanics, how private deals actually work, how to read what you're being offered, and the questions that separate sophisticated investors versus everyone else. In the next video, I'm breaking down preferred returns, one of the most misunderstood concepts in private investing. If you've ever looked at a deal and wondered, what does an 8% preferred return mean with a 70-30 split actually mean in practice? This is what we're covering. See you there.